Hey everyone, and welcome back to the channel where we demystify the markets and uncover unique opportunities. Today, we're diving deep into a fascinating microcap that has recently appeared on our hard-to-borrow screener, NCRA Inc., trading under the ticker NCRA. This isn't just a generic lesson. We're going to examine NCRA with a magnifying glass, looking at its specific numbers and what they could mean for potential volatility. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. NCRA Inc., or NCRA, operates in the consumer defensive sector, specifically within packaged foods, with a focus on land-based recirculating aquaculture system services, fish farming, and producing food products. It's a tiny company with a market capitalization currently sitting at just $2.04 million. Looking at the recent price action for NCRA, it's been a roller coaster. Today, the stock is up 5.52%, which is a nice bounce. However, over the last 5 days, it's done 6.71%, and if you stretch that out to the last 30 days, NCRA has plummeted by a significant 72.28%. Volume today is pretty light at 162,300 shares, especially compared to its 30-day average volume of nearly 1.3 million shares, putting its relative volume at a mere 0.1x today. Short chart, NCRA 30-day price/volume. What is cost to borrow and why it matters? So, what does it mean for a stock to be hard to borrow, and why is that important? When you short a stock, you're borrowing shares from someone else, selling them, and hoping to buy them back later at a lower price. The cost to borrow, or CTB, is essentially the annualized interest rate you pay to borrow those shares. It's a critical indicator because a sky-high CTB, like the one we're seeing with NCRA, tells us that there's a massive demand from short sellers to bet against the stock, or perhaps more importantly, there's a very limited supply of shares available to borrow. When the CTB starts to climb, it puts significant pressure on existing short sellers because their cost of holding that short position goes up, often dramatically. Why this stock is hard to borrow right now. Now let's talk about NCRA Inc. specifically. NCRA has an absolutely eye-watering cost to borrow fee of 10.95.9% annualized. To put that in perspective, this means if you borrowed shares worth $100 for a full year, you'd owe over $1,000 in just borrowing fees. We also see that there are only 45,000 shares currently available to borrow, which is an incredibly tiny number for a stock with an estimated float of just 0.5 million shares. This creates a classic supply and demand imbalance. Our internal composite squeeze score for NCRA currently sits at 55.7 out of 100, indicating it's certainly on our radar. Now, it's important to note a nuance here. While NCRA's current CTB is astronomical, it has actually decreased by 548 percentage points over the last 5 trading days. This might suggest a slight easing in the immediate borrowing pressure, but the underlying cost remains incredibly steep, signaling that shorting NCRA is an expensive proposition. Squeeze mechanics explained. So how exactly does a short squeeze happen? Imagine short sellers have borrowed and sold a substantial portion of NCRA's tiny float. With only 45,000 shares left to borrow and the nearly 1100% CTB fee ticking higher, short sellers start feeling the heat. If any positive news emerges, or even just a surge of buying interest, the stock price begins to rise. This rise in price, combined with the exorbitant borrowing fees, can force short sellers to buy back shares to close their positions and cut their losses. But here's the kicker, when they buy back, they add to the buying pressure, pushing the price even higher, which forces more short sellers to cover. It's a chain reaction, creating what's known as a short squeeze. Short animation, short covering snowball effect. However, a high cost to borrow does not guarantee a squeeze. It can also simply mean that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay those high fees to stay short. Dilution risk check. One of the biggest silent killers of a short squeeze thesis is dilution. Dilution occurs when a company issues new shares, increasing the total share count and potentially lowering the per share value. Crucially, new shares also provide more supply for short sellers to cover their positions without impacting the price as much, effectively negating the hard-to-borrow dynamic. The good news for NCRA is that we haven't found any recent dilutive SEC filings, such as SMINUS1, SMINUS3, or 424B, in the last 90 days. This means, for now, dilution isn't an immediate concern for potential squeeze. Recent reverse split watch. It's also critical to note that NCRA executed a 1-for-30 reverse stock split just 8 days ago, on July 7, 2026. A reverse split reduces the number of outstanding shares and resets the share price higher proportionally. While it doesn't change the company's underlying value, it does reduce the float size even further, which can amplify volatility. Historically, many microcap stocks, particularly those that have recently reverse split, tend to see renewed volatility or even a price pop within about a month after the split. This isn't a guaranteed outcome, but it's a pattern we've observed in some highly speculative names. NCRA's substantial 72.28% drop over the last 30 days, despite the recent split, underscores the high risk involved here. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, given all this, what should you be watching for with NCRA Inc.? The most critical factor would be a significant surge in buying volume. Remember, today's volume was very low at 0.1x its average. For squeeze to ignite, we typically need to see a dramatic increase in trading activity, especially on upward price momentum. Keep an eye on the cost to borrow. If that recent negative momentum reverses and fees start climbing again, it would signal increasing pressure. Also, monitor the number of shares available to borrow from that tiny 45,000 pool. Any further reduction would tighten the noose on shorts. Finally, given NCRA's recent reverse split, watch for any sustained upward price action over the next few weeks, keeping that historical pattern in mind. This is a microcap with a very small float, making it incredibly susceptible to large price swings in either direction. NCRA Inc. NCRA presents a fascinating case study, with its astronomical cost to borrow, extremely limited share supply, and recent reverse split, all contributing to a relatively high squeeze score. However, today's low volume and recent easing in CTB momentum suggest that while the ingredients for extreme volatility are there, a full-blown squeeze isn't actively unfolding right now. This is a highly speculative situation in a tiny company. Always approach such opportunities with caution and a thorough understanding of the risks involved. If you found this deep dive into NCRA insightful, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments what other stocks you'd like us to cover. We love hearing from you. Thanks for watching, and we'll see you in the next video.